Welcome to The Tax Factor, the top 20 business and investment podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Roger Holman and Neil Insull.
Welcome to The Tax Factor. I'm Roger Holman.
And I'm Neil Insull.
This is the first episode after our summer break. And they say a week is a long time in politics. The last 6 weeks has certainly been eventful. The last Tax Factor podcast was with Heather and Nimesh the morning after the election. We've already got a date for Rachel Reeves' first budget, and the new government wasted no time in outlining some of its policies and ideas.
So stay with us over the next 12 months and we'll be covering all the latest tax news and updates. And as always, trying to break down what it means for you and your business. You'll hear some familiar names returning and a few new ones, all giving you their perspective on proposals, tribunal rulings, and no doubt some bizarre VAT cases and a particular favourite, everyone's HMRC's performance.
I also expect that topics of the high-income child benefit charge and non-doms will be a recurring theme over the next 12 months, has been over the previous ones. Neil, as we clear away the pile of manifestos, what are your thoughts on the last few weeks?
Well, as we said at the top, there's been a lot going on. There's been the outcome of the election, so we've got a new Labour government in power. And since Rachel Reeves has become the Chancellor, she's announced a new budget. So budget day on the 30th of October. And we're all waiting with bated breath for what's going to be in that. And I think, Roger, what better time than actually put our top 5 predictions for the budget out there now for everyone to critique and perhaps complain about in terms of what we're choosing. But I think we've agreed on a top 5, and I don't think it would be wrong necessarily to start at number 5. Roger, I'm going to go with pensions reform. And I think it's probably maybe an outside bet, but it's worth mentioning because I think a lot of commentators have been mentioning pensions. I think everyone's sort of agreed that there's plenty to do, lots of complication in the rules, and there will be some changes that can be made which may well add some revenues to the Treasury pocket. One of the things that I think a lot of people have been talking about is a new rate of tax relief on pension contributions. At the moment, we're getting marginal rate relief, but some people are talking about maybe even a reduction in the relief to 20%. What do you think, Roger?
It sounds like a really simple, easy way to make money, certainly for the government. But as is always the case with tax, there's this weird law of unintended consequences. The last time they fiddled about with pensions, it got the doctors into all sorts of difficulties with pension charges. And of course, any fiddling around with the rate of relief will affect those doctors' pensions again, because they're on what's called a defined benefit scheme rather than what you and I have, which is the plain old money purchase. And what that means is they don't actually necessarily make physical contributions to their scheme and then get tax relief on it. The government really just gives them a final salary pension when they leave service. Working out the rate on how that will work is going to be a hugely complex task.
A good point. Well made, Roger. I think the other thing on pensions that I've been hearing banded about is perhaps a reduction in the lump sum allowance. So at the moment, we can take 25%. And as I near retirement, I'm quite looking forward to taking a reasonable amount out. Maybe reducing that, maybe even down to 20%, maybe even lower, or getting rid of it altogether. Perhaps not, but something that I think we should probably keep an eye on.
I think that's possibly something that's more simple to introduce. And I did like the way you said it's a lump sum allowance, not the tax-free allowance, which most people think it's called.
Roger, I think we'll go to number 4. What's number 4 on our list of the top 5?
Well, I think number 4 was inheritance tax. We've kept it quite high on our list, right up there at number 4, in part because actually inheritance tax doesn't affect that many people. I think at the last set of stats, it was about 6% of the estates in the UK actually paid inheritance tax, which is a very small number. But where we think that there might be some little tweaks to generate a bit more cash for the Treasury is around some of the reliefs, particularly following the IFS report that was done at some point last year, where they were actually suggesting some restrictions on business reliefs and agricultural reliefs. So that's reliefs for those people that run their own business and those poor farmers.
Like Clarkson. Poor Clarkson.
Exactly.
Poor Clarkson.
I mean, the main reliefs in terms of a business side that they're talking about restriction really are ones where it's a little bit esoteric. It's not really intended. So the main intention behind business relief for inheritance tax is so that entrepreneurs can pass on their business to their family tax-free. Unfortunately, because of the wide rules in inheritance tax, it actually applies to a vast, much wider array of businesses than perhaps you would think it would apply to. So even the likes of Dobby's Garden Centres were included.
Thanks, Roger. What about number 3? Well, what do you think, Roger?
Well, I think number 3 we had down as... What did we have number 3 at?
Roger, I'm going to help you out here. Well, at number 3, Roger, we've got capital gains tax.
Excellent.
Capital gains tax, I think it's everyone's favourite. It's certainly our CEO's favourite tax at the moment. It only raises about 15 billion a year, but it seems to be one of those taxes that everyone's found quite interesting to talk about. And since Rachel Reeves has started talking about changes in plugging the tax gap that she suddenly found, because capital gains tax is one of those taxes that she didn't announce as one of those where the rates weren't going to change. So it may well be something that she chooses to change. I think politically that seems to be quite a right balanced tax to raise, given Labour's commitment to honour working men and to perhaps levy more taxes on the better off. So maybe we're going to see a change in rate of capital gains tax, maybe introduce yet another rate, or maybe just bring everything together at a higher rate, maybe at the income tax rate, maybe not as high as that, but perhaps if it was as high as the income tax rate, maybe at 45% or whatever the marginal rate is for the individual, bring in some sort of taper as they used to have.
I think that is something that a lot of political commentators have been speculating about. I was doing some research on this around the election and afterwards, and actually HMRC released some data at the end of June this year, giving their forecasts of how much tax would be raised by increasing capital gains tax. Well, they actually looked at all of the taxes, but here we're talking about capital gains tax. And if the government decides to increase higher rate capital gains tax by 10%, HMRC actually estimate that in the first 3 years, there would be a reduction of about £3.5 billion in tax receipts.
And tell us why, Roger. What's going on there?
Most of that really comes down to behaviours. Most people that actually pay capital gains tax don't have to pay capital gains tax, if you kind of understand what I mean. Capital gains tax is paid when you sell an asset at a profit. Most people that actually pay capital gains tax have got investments and they buy and sell these investments, and sometimes they make profits, but they don't actually have to buy and sell the investments. They can just sit on those assets and hold them for a long time, hoping that the rate will decrease again.
I think the other things that are worth just mentioning before we move away from capital gains tax, some other commentators have talked about maybe capping the principal residence relief, so the relief that you get or the exemption you get on your main home. I don't think we'll see the end of that, but we may well see some changes in terms of what that might be capped at. I think people are talking about taxing things like gambling winnings, which aren't taxed at the moment, maybe removing the exemption on certain other assets which have so far escaped CGT, such as classic cars and wines. So maybe at the fringes we'll see some changes. I mean, it won't make a lot of money, but at least it sort of adds to the idea that, you know, everyone should be paying some of the tax that needs to be found. Okay, let's move to your all-time favourite, Roger. I think at number 2, what we're going to be talking about here is the non-dom regime.
Yeah, thanks for that, Neil. As you say, I do love talking about non-doms and the way the tax system works. Our old tax system discouraged non-doms from bringing in their overseas income and capital gains. So, you know, we don't want them to come and spend money in the UK. The new system being proposed suggests that they'll be able to bring in that money tax-free, but only for a very short period, only 4 years. I mean, there's been an awful lot about these changes to the non-dom rules, whether inheritance tax is going to be caught, how that's going to work, and indeed actually whether it'll increase any tax in the long term. The problem that the government faces is there is a very severe lack of data around all of this. The reason there's a lack of data is actually because the income and capital gains for a non-dom simply didn't have to be declared. If they didn't bring it into the country, they didn't have to tell HMRC how much they weren't bringing into the country.
I think around the non-dom changes, I think there is a political imperative there to demonstrate again that Labour have this forward-thinking idea about modernising the legislation and perhaps bringing some fairness, which is perceived to be unfair at the moment. So we're definitely going to see something, I think, along those lines in the very near future. How much it might collect is very debatable. What we're going to talk about now is the number one prediction. It's not even a prediction. We know this is going to happen.
Of course, it hasn't actually happened yet, though, Neil.
It hasn't happened, but it has happened, okay? Well, that is VAT on school fees. Now, I'm not a VAT expert, but I'll tell you what I do know, is that at the moment, if you're paying school fees, it's very likely that you're making a prepayment of school fees for next year. Now, those prepayments, as was announced quite recently, are now going to be subject to VAT at 20%, the standard rate, because from the 1st of January 2025, school fees are going to be VATable at the standard rate, and anyone who is making a prepayment of fees from the 29th of July onwards from this year is caught by what's called forestalling legislation, which brings in those prepayments into the new VAT regime. So a lot of planning was done by schools and parents to try to pay these school fees early. But if you hadn't paid them by the 29th of July, then you are going to be hit with a 20% VAT charge on those fees, which was a little bit of a surprise move. I think people were expecting the introduction of those VAT charge to be brought in later, but it is going to be from the 1st of January next year. I saw in the Times today that there was a letter from a group of head teachers from independent schools all explaining that this was a very, very bad idea and suggesting that at least the government could do would be to listen and actually wait a little bit longer for schools to get their plans in order. But maybe that is all a little too late. And I think we may well see on budget day confirmation that all this, what I've just said, is going to be brought in on the 1st of January.
I think that's right, Neil. I think politically, again, the Labour Party have committed to this, and I don't see how they can back away from it. It comes on the back of a lot of independent schools increasing their fees significantly this year as well.
Yeah, it's a bit of a double whammy for parents and anyone else who's funding their children's or grandchildren's education. Look, I could go on and on about how many people this is going to affect and how few it is compared to the vast majority of the population, but it is 7% of children that are going into private education at the current time, and that is quite a lot of kids and a lot of parents involved, and a lot of those are our clients, of course, Roger.
So, Neil, all of these changes that we're half predicting, half already know is going to happen, that we think might be in the budget, of all of them, none of them are really going to generate anything close to that £22 billion that Rachel Reeves has suddenly discovered as a black hole in her pocket.
It is very debatable whether they get anywhere close. VAT on school fees is unlikely to raise more than a couple of billion a year, I think, is the projection. Any changes, we've already said, to CGT are going to be pretty minor in the scheme of things. Non-DOMs, we've got no idea what the impact of that is, and it's difficult again to tell on pensions and inheritance. Again, the amounts are relatively small. The government is stymied by its own commitment to keep income tax and corporation tax at the same rate. So I don't know really how they're going to juggle this around, but there were some figures today which announced a very significant increase in tax take. So maybe the plug is not so much about filling the gaps with new tax legislation, but actually the fact that they're bringing in more money than they perhaps expected to.
It's all about growth, isn't it, Neil?
It's all about growth. By the way, talking about growth, I do have a whimsical VAT case.
Fantastic.
Do you want to hear my whimsical VAT case? And it's not that whimsical, actually.
We love a whimsical VAT case on the Tax Factor.
It's time for another bizarre VAT update.
Let me just talk about a tax case which was decided against the taxpayer. okay, which is never good news for the taxpayer. But I think it tells us something a bit about the VAT system, how complicated it is. Okay, there's a company called Mark Glenn Hair Loss Clinic or something like that, and they'd been charging nothing, zero rate VAT on some of their hair loss treatments, particularly for women who are losing their hair, and it involved some sort of very specific system of introducing their own hair and artificial hair and bringing it in and having that treated regularly. Anyway, they argued that this should be zero rated because it was essentially a treatment to deal with the disability, and the disability being hair loss. What the court decided, what the tribunal decided, was that actually, losing your hair wasn't necessarily a disability, and people could lose their hair not without necessarily through any sort of medical problem. It was just a simple case of people getting older, I guess. So they said, no, this is not for a disability, and therefore you need to start charging 20% on your hair loss treatment. So an interesting case about disability, about people generally expecting something not to be within the charge to VAT, very much like school fees.
Exactly. Well, I think we're nearly out of time for this week.
The Tax Factor.
As it's our first episode after the break, I should remind you that we release the podcast every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen whenever is most convenient, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review.
If there is any subject that you would like us to cover, you can contact us via the Tax Factor page on the Blick Rothenberg website. We're sorry, but we can't give individual advice, but always keen to hear from what you would like to hear about on our show.
Next week, Nimesh Shah, CEO of Blick Rothenberg, is here along with Heather Self. But for now, from myself, Roger Holman,
and me, Neil Insull,
it's goodbye until next time.
Goodbye.
That's the Tax Factor. We'd like to thank you for making us one of the UK's top 20 podcasts. Find all our previous episodes wherever you get your podcasts. And join us again next time on the Tax Factor.